All right, let's talk about a classic Wall Street head scratcher. What on earth happens when a company completely demolishes its profit expectations, but the market just hammers the stock anyway? Well, that's exactly what went down with SAIC. So let's get right into their very, very eventful second quarter.
So picture this. It's September 4th. The earnings report drops and boom, SAIC's stock takes a nosedive, plunging almost 7%. And get this, it happened on nearly 3 times the average daily trading volume. That's not just a little selling, that's a stampede for the exits.
Which brings us to the big question, right? How does this happen? SAIC didn't just beat its profit estimates. They beat them by a whopping 62%. So how does that kind of blowout performance lead to a nearly 7% stock drop? Well, as we're about to see, it's all about that classic Wall Street battle between what just happened and what's coming next.
Okay, so to really get what the market was thinking, you have to understand that the company was basically telling two completely different stories this quarter. One story was all about amazing profitability, and the other, well, it was about sputtering growth.
And here are those two stories laid out side by side. I mean, look at the left side, the profitability column. It's beautiful. Net income is way up, margins are getting better, and of course, that monster 62% earnings beat. But then you look to the right at the growth column, and it's a totally different picture. Revenue didn't just miss what analysts were hoping for, it actually went down compared to last year. And that right there is what completely freaked out investors.
And I really want you to see just how huge this earnings beat was. The experts, the analysts, they were looking for about $2.24 per share. SAIC came in and delivered $3.63. They didn't just clear the bar, they launched it into orbit. But as we're about to find out, the market was already looking way past this number.
See, the market's brutal reaction wasn't really about the quarter that had just finished. It was all about the road ahead. The real story, the one that absolutely crushed the stock, was buried in what management was forecasting for the future.
During the earnings call, the CEO got pretty specific and laid out 3 main reasons for the weakness. First, he said money from their existing contracts just isn't flowing in as fast as they'd hoped. Second, some of their projects are hitting snags and disruptions. And third, those big new contracts they're trying to win, yeah, those are getting delayed. Put those 3 things together, and you can see why management had to slam on the brakes. And here it is. This is the number that caused the panic. Just look at that top line for revenue. Management had to slash their forecast for the full year, what Wall Street calls guidance, by almost $400 million. Now, what's crazy is they actually raised their outlook for profits and cash flow. But the market has a one-track mind, and all it heard was that growth is slowing down. Big time. But management's story isn't about panic. Not at all. In fact, they're trying to frame this whole situation as an opportunity. A chance to hit the accelerator on a strategy they've apparently been working on for a couple of years now.
And this quote from the CEO really says it all, doesn't it? We are determined to not waste this crisis. He's basically saying, look, this isn't some new fire we're trying to put out. He says this is just the catalyst they needed to speed up a plan they already had in place to become more efficient and focus on more profitable work.
And to prove their point, they highlighted $2.6 billion in new contracts that they won just this quarter. And we're not talking small deals. We're talking almost $1 billion from the Air Force, over $700 million from the Treasury. So this tells us that people still want to buy what they're selling. The demand isn't the problem. The real issue is the timing. When do these huge new contracts actually start turning into cold, hard cash? So let's recap. We've got fantastic profits right now, but some really big question marks about growth down the road. Where does that leave the stock? Let's dig into what we're watching for and give you our final rating. So management was pretty upfront about what needs to happen. Essentially, those 3 problems they mentioned, they need to turn into positives. So what everyone's going to be watching for next quarter is proof. Proof that they're getting paid faster on existing contracts, and proof that those huge new deals are getting up and running on schedule. These are the key things to watch. So for our rating on the stock, we're landing on market perform. Look, the company's ability to make money and generate cash is seriously impressive. But that massive cloud of uncertainty around revenue growth is just too big to ignore, and it keeps us on the sidelines for now. This is a classic show-me story. Management has to prove they can fix the growth problem before we can get any more excited about the stock.
Now for our outrageous but plausible idea.
SAIC has gotten beaten up way worse than its peers in the aerospace and defense sector this year. So a potential play here could be what's called a pairs trade. The idea is you bet on one stock to do better than another. In this case, you'd buy SAIC, go long, while at the same time selling or shorting the sector ETF. It's really a bet that SAIC can fix its own internal problems and that the huge performance gap between it and its rivals will start to close.
And of course, we always have to end with this very important reminder. This explainer is just for informational purposes. It is not and should not be considered financial advice.